Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City, and I'm here to bring you some trading levels for the upcoming week of November 20th, 2023. I'll be looking at some popular stock symbols. Before I get going here, the usual disclaimer, Precision Trading Labs, everything I present here is for informational and educational purposes only, and Precision Trading Labs, we are neither money managers nor financial advisors. Also, if you find what I present here interesting, I would be grateful if you would subscribe to our YouTube channel, give us a like, and also you'll see a link in the YouTube description where you can actually schedule a call, and I would be happy to tell you a little bit more about the supply and demand concept that I'll be talking about here in the creation of various trading levels. So anyway, that's what I got. So let's take a look at the charts. We're going to start here with Apple, in fact. Um, Here's where we closed on Friday here at 189 and a half or so. And right now, here's where we're sitting here. And the levels that I'm looking at here, above and below, this is an area of demand over here. Price came up here from this green candle here. It consolidated here. Notice that very bullish green candle, and then a pause, and then notice this march of continued march up there. So this is an area where when price returns to this region, if we get a pullback after this area of consolidation, we can expect that this is an area of future upward price pressure. There may be some unfilled buy orders there, but this was an area of interest where essentially people wanted to buy. Price was only in here for a brief amount of time. And so when price returns here, there is a reasonable expectation that we could see a pop from here. We can expect a bounce. So this is an area and this is characterized here by an exhaustion of sellers. So when price came up, buyers and sellers were in agreement within this range. And then at some point, there was an exhaustion of sellers. And for these trades to then have occurred, buyers had to run up the price chart until they encountered willing sellers. And so this is how this occurred. And so right in here, where there was this consolidation and agreement, you can think of the demand. We had a demand for shares within this agreement, within this range, as well as a supply of shares available within this range. And then at some point, once the willing sellers disappeared here, all you had left were the demand for shares. But there was no supply of shares here. Consequently, we think of this as a demand zone here. Okay, so and when price returns to the demand zone, we then expect price to bounce from there. Similarly, up here, price rallied up here, consolidated, and notice how it slammed down there with a very bearish candle. There was another shot down, and of course then this major gap here. Okay, and that's that same narrative that I just described for demand, but on its head. So right here, we basically had an exhaustion of buyers in the region. And again, these trades then occurred because essentially the sellers ran down the price chart until they encountered willing buyers in this case. Okay. And then this was also preceded by a narrow area of consolidation. Okay. And that was relatively brief. So again, if price returns to this region, we would then be looking for a bearish move, a down move from here. Okay. And so that's the narrative for this. So this, of course, we refer to as a supply zone because within here, there was supply and demand. They were in balance here. And then supply and demand went out of balance. There was no supply left here. Excuse me, no demand left in here, only supply. And so consequently, we think of this as a supply zone. So this is a supply zone. This is a demand zone. We take bullish trades out of supply and we take bearish trades out of supply and bullish trades out of demand. Okay. And so this was an area right here. This is a demand zone here. And then also below here at this pivot, if you notice, I have this notation 2H. That's a 2-hour chart. So I would drop this chart down from a daily to a 2-hour, and then this resolves into a quality demand zone there. Okay, and so that's the other region. All right, so In terms of what we have here, let's get these out of the way for a moment. So this is at 180. So this demand zone here is at about 183.5 to 181.5. So it's about a $2 range. Okay, and then below that, of course, much further below is that level there. In terms of the distance of where we are, I have these noted on these magenta lines here. Okay, so this level here is about 3% down from where we closed on Friday, and then this one is about 3% higher. Okay, so these are the areas of interest to us on Apple. If we go to Google, here is a demand zone, excuse me, on Google here. So we had a rally, a base, then the gap. It's not a spectacular demand zone because of the fact that the move did not go very far. So from a risk reward perspective, this is not the greatest level, but this is an area we would probably expect to see at least a short-term bounce from here. Okay, and that's about 2% down. Okay, so how would we express the trade once it actually got back here? Well, obviously, the most straightforward thing, of course, would be just to buy Google. But there are other ways one could express the trade when the price actually got back here. And so there are other ways to express it in terms of from a demand zone. So again, we could buy stock, we could buy a call. Okay, and that would simply be, you could buy one, either at the money or a bit in the money. Let's say if you put your strike at around 130. Behind this zone, then this would be about $4 in the money. If you bought the 135, of course, you would be buying it more or less at the money. And of course, if you bought a call further up, then you'd be buying something out of the money. So you have your choice of how you want to structure that trade. And then two other simple ways to express a trade would also be to buy a bull call vertical debit spread, where you would buy a call and then sell another call above. That would drop the premium down and also make it a gentler trade by essentially mitigating the various Greeks. So you'd be running less delta. You would also make this thing less sensitive to time decay, and so you essentially would construct a less responsive, gentler trade. By doing the bull call vertical spread. And then the last thing you could do here is you could collect premium. And so what you could do is then construct a bull put vertical spread. And then what you would do then here is, of course, you would sell a higher strike put, and then you would buy a lower strike put, and that would define and it would define your risk. Okay, as opposed to having effectively unlimited risk if you simply just sold a naked put. Okay, and so that's right here. So we sell a bull put vertical spread, and you would sell the put at a higher strike, and then you would buy the put at the lower strike. And of course, in both of these, as a vertical, you would use the same expiration date. Okay, so right here, that's the demand zone for Google is sitting around 2% from its close on Friday. And then there's another one that's much further down, and that's obviously then that's about 8%, 7.5% down. Okay, up here we have what I'm referring to here is a tested supply zone. Okay, price came up here, kind of waffled up here, and then eventually dropped. But if we go back in time, okay, there was the original supply zone. Price rallied up here, then dropped. Okay, so now price has now been back there again. Okay, and so it was there again. So when this thing returns here, and of course this is also where its 52-week high is, it could just blow right through here. So we would I wouldn't just automatically short out of this at all, because this is weakened tested supply. Okay, and I think this is more at this point resistance rather than supply. And it's also sitting at the 52-week high. So we'll certainly watch that. Okay. We take a look at Facebook, Meta. Still have to get used to that. So right here's where we closed at 335. Okay, down below here, there is a demand zone, but this is actually fairly distant here. This is about 7% down. Okay, go from about 335 to about 313. But this is really kind of the next area of really clean daily demand. Within here, there is actually there is probably some 2-hour if we broke this down into a 2-hour chart, there's probably something in here, and I'll probably be constructing that and sharing that with our subscribers in the early in the week here. So this is probably another area in here that we could be looking at here. That's sitting in the area of 320 to about 315, right in there. Okay, so there's that. The other thing that's interesting about this, though, is because of the fact that this is actually, I'm thinking of this as very, very beaten up resistance. Okay, if we go back in time here, and we go all the way back to here, okay, so price came up here, okay, dropped out of there. Okay, now then it popped up here again, okay, and then it's been back there numerous times. It came back here again, and now it's in here again. This is about the fifth visit ever since that original supply zone got created. It's like I tend to think of resistance as more of regions rather than discrete lines. I know a lot of people they plot lines of support and resistance. Personally, I don't believe the market is anywhere near that exact. I think of support and resistance as fuzzier concepts, and so as a result, I construct support and resistance zones as opposed to discrete lines with a single price. Okay, so this resistance zone here basically runs from approximately 325 to 336. This is about a $10 zone in there. And if you notice now, we are sitting right at the top of it again. It made these signs it wanted to break. You can see right there, those blue crosses there, that's the 52-week high. And if you notice, it's trying very hard to blast through this. I'm thinking of this as used up resistance or supply up here. Consequently, if this thing goes to its 52-week high, I suspect that we're now looking at a run to the next area of resistance, which is sitting at around beginning at around 350, and that's about 3% up. Okay, so one could expect. Okay, and if we go back and take a look here, we'll notice here. Here is that area. Okay, and then right up here. Okay, there is the sort of the next area of resistance right here. And if you notice, these price came up, and then we had these wicks in here. And so this could be an area that would actually stop the trade once you got the breakout out of this level. But within here, this could I would not be surprised at all if the market is showing general strength. We could see a run from here to there. Okay. After that, there's really no clean clean supply until we get to that region up here. And that's sitting at around 377 down to about 370. But in the near term, again, what I'm really looking at, what I'm thinking about here for this is down here, potential demand in this 2-hour zone, and then looking at a potential breakout if we get above this 52-week high, because of the fact that this thing is about to blast through resistance that's been pretty beaten up. Okay, so that's the story with Meta. We take a look at Netflix here. Okay, so here is Netflix. In fact, right here was an area of supply that we had last week. And in fact, sadly for us, this actually turned into a losing trade for us. But everything about this mapped out perfectly. It was a rally, a base, and a drop, and a fierce drop there. There was the consolidation here, the structure here all worked out. Everything was perfect, except for the trade didn't work. So right here was our entry point where we actually bought a put. This is where our stop out point was, just behind the supply zone here. And as we know, trades do not work all the time. You simply do the same right thing over and over, and a certain percentage are going to fail. This one failed for us. But we essentially did everything right here, and we controlled our risk. So again, this was our entry. That was our stop out. And so this is where we are now. We're actually looking right here. This is actually on the doorstep of another supply zone here. There's a rally, a base. Notice, of course, that major drop out of there. And so, okay, so this was an earnings gap. Okay, so with this gap over here. So the one thing, this thing I think is a little less impressive than it looks. If you see that cross there, this is an earnings gap. It's not a trading gap. Or from something from regular trading. Consequently, if price gets up here, I could see getting a drop here, but I don't necessarily know that we're going to see that kind of fierce drop because of the fact this was a news-driven earnings gap. So keeping that in mind here. So this is the aggressive way of drawing this level. The other way we could, of course, draw this level is to draw this level, the front line at the body of that candle, and then so that would bring it up to here. So depending on how aggressive you want to be, that's at 476.5 or so, and then the most aggressive interpretation of that level is sitting at around 470. Okay, so but these are the two ways we can look at this in terms of expressing a bearish trade out of this region of supply. Okay, so so in terms of distance. If we go back here, obviously this is sitting right at the doorstep. So this front line is sitting here at 0.5%. And again, if we decide though that we were going to use a slightly more conservative look at a slightly more conservative interpretation of this zone, then in fact the front line would be sitting at around. This would be about 2% higher. Okay, so this is about 0.5% here, okay, and then it's about another 1.5% until you get to that front line there. So depending on how you want to interpret that. And then again, you can express the same way we described that on, I think, Google, we can express a bearish trade here. We can obviously short Netflix here, but having said that, it's an expensive stock. So I would be more inclined probably to be buying a put, or even better, in this case, probably doing a bear put vertical spread here. And that would, of course, then lower the premium on that. Okay, so that's Netflix. Lastly, we'll take a look at our buddy Elon and Tesla. So here are two very, very clear-cut supply and demand zones on Tesla. Okay, here price dropped, based, and then dropped out of there. Very clean. Okay, came down. Okay, then right here, similarly, there's the mirror image of that, and then we have that. So we're kind of sitting right now in between these zones. So we're a fair distance away from both of these. This is about 7%. The supply is about 7% higher here, and then of course, and this is about 8% below. So there is a bit of distance that would need to be covered here. But these are two areas where we could express the trades that I described. The other thing is, because we're actually midway, pretty much in the midpoint between supply and demand, another popular way, another good way to express a trade out of here would be to actually enter into an iron condor, where essentially you're selling a bear call vertical spread above, and then you're putting in a bull put vertical spread underneath, and you put them in simultaneously. And when you do that, that's of course referred to as an iron condor. And so you can collect premium by essentially, from the combined, the combined two credit spreads that you're putting on at the same time. And so having the midway in between supply and demand is usually an ideal place to do that. So that's an extra way of expressing a trade under those circumstances. So at any rate, that's what I got here. As I said earlier, we'd be grateful if you would, give us a like on our YouTube channel, subscribe to it, and then also here's the explanation that I offered before about these supply and demand zones, and I would of course be happy to give a little further explanation. So if you take a look at our subscription, our description page, you'll see that there is a link that you can set up, and you can set up a brief call, and I'll be happy to go through this with you briefly. So and as well as take a look at any symbols that you might be looking at. So again, thank you very much for your time. This is Mitch Firestone, and I will see you next time. Take care.